Programming note as we head to break, we have a huge list of executives on Power Lunch over the next 2 days. Tomorrow, we'll speak to the
Oh wait.
CEOs of Valley Bank, Union Square Hospital.
All right. So yeah, the Fed hiked rates 25 basis points as expected. As expected. What up, Slime Z? Pop and drop play. Yeah. I don't know. I think there's a lot of uncertainty right now. Um, maybe we pop and then we sell off a little further. So I don't know. I think it's hard to really guess anything currently. I'm just gonna watch how the dollar responds. I'm gonna be watching how the dollar responds, how bond yield respond, how the bond market responds. See the dollar dropped a little bit going throughout this meeting. What else are we getting? So some of the comments here, and we'll be back on CNBC Live. We'll play it on here live. If you are on TikTok, we're playing it live on YouTube, so you can actually see it. I can always turn the screen, or you could just listen, or I could turn the screen. I guess I could turn the screen if you guys wanted to. Let me see. Let me know if you guys want me to turn the screen. Let's see. We can do. Actually, just let me know. If not, just come to YouTube. Just jump over to YouTube. We already got some people on YouTube because I'm going to type in the comment section kind of what he's saying. I'll be typing in the comment section to interpret his tone. I think he's going to be, what up, Hassan? What up, Manny? I think he's going to be trying to stay neutral as usual. It was a unanimous decision. Here's the FOMC rates. Here's the actual statement. They said credit card conditions are likely to weigh on economic activity, hiring, inflation, to the extent it remains uncertain. So that's a dovish statement right there inside the actual FOMC statement. It's pretty short. Recent indicators suggest the economic activity has been expanding at a moderate pace. Job gains have been robust in recent months, and the unemployment rate has remained low. And actually, let me remove this over so I don't have to look over there. And we got about 13 minutes before he actually comes out and starts speaking. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remain uncertain. The committee remains highly attentive to inflation risks. The committee seeks to achieve maximum employment and inflation at the rate of 2%. The guy's just talking over the longer run. So yeah, it's same thing, 5.25. I don't think it's an appropriate stance of monetary, but commodity, same thing, right? Same as usual. We're gonna have to get the questions. We're gonna really need the questions. They're trying to stay robotic as possible and basically telegraph nothing, neutrality. They're trying to be as neutral as possible. It looks like. See if there's any other signals. And again, if you want to see that video or you want to see them live where we are on YouTube, any hope for a pause? Well, I mean, I don't know. We're a lot stronger than usual. So, you know what? At this point, I'm a little uncertain, right? Here's the issue. Oil price is still spiking, right? Oil did not roll over yet. So oil coming up, gasoline prices are already starting to rise a little bit, and future expectations. So shoot, they could and that's what we're going to listen for. Are they going to signal another hike, or are they going to stay pretty neutral? Fed continues to signal further hikes ahead. And they could keep doing that because the labor market, GDP, look at GDP got revised higher. So economic growth is better than expected. And they might just keep hiking, right? Especially with government spending still where it is. I don't know. I'm a little less bullish. The thing that's going to get the market bullish is going to be earnings. And but as far as the Fed, like, yeah, we're seeing inflation cool, but this next print should actually slow down because of oil prices, right? Energy starting to factor in. So I don't know. I don't think we're going to get a pause. It would be bullish if you talked about a pause, but I don't see it happening just because if oil is breaking down right now and we got unemployment coming down, payrolls coming down, maybe, but that's not what we're seeing. We're seeing a hotter than expected, labor market. So possibly not in the cards. Let me see. I'm going to try to keep track of anything that changes in the statement. The market's not even reacting. The market is not reacting. Let's see. Fed hikes 25 basis points expected. Yeah, as expected. Everything is as expected. It's going to come down to his comments, right? Which is why we're taking a look here at the actual. We got to keep track of the actual questions that are asked to him. I'll be typing in the chat to give you my feedback on what I think is going on. So I don't want to interrupt the stream when he actually starts speaking. Make sure the sound is good. You guys can hear. I'm going to turn the sound on just to make sure it's we can hear that.
Conditions. And if you look at other measures, including the the SLUIS loan officers survey, that's
just give me a thumbs up. I think I'm very uncertain right now about what's going to happen with the Fed, right? We'll see the CME data to see what the market. It's all about how the market reacts. It's all about how the market decides to react to this, to his press conference. And we still have earnings. Earnings still big factor, right? Biggest factor is going to be earnings. Let me see. What's the dollar doing in the immediate? Dollar's getting stuck. See, the 2-year yields move. They moved up. 2-year yields actually started to move up a little bit. Okay. Oil. Hopefully oil peaks and rolls over, right? VIX not moving. Nothing on the VIX. No volatility. Bond volatility sort of catching a bit here. Triple B spreads. So credit risk is non-existent. Credit risk is rolling over. We're neutral. Right now, the market is neutral. Market is very neutral. Initially, we did bounce on the Qs. We did bounce on the S&P. Advanced decline still kind of negative. Let me see. I'm going to throw SPY up here on the chart. So yeah, we got about what? We are T-minus 8 minutes before he comes out and starts spitting to the market. I think it's really just boring right now. I don't see any signals. It's going to be interesting. We'll see how they actually question him. That's always interesting. How do they question him? What are the main questions to ask? I think the pause is going to be important. Are they going to give him a pause, right? Or is anybody going to say, are you looking for a pause? Or is there any chance that you may pause? And how he responds to that. Is it going to be a little more lax? Is it going to be more tight and aggressive? Remember, he's been a little more dovish. We have if you're in the newsletter or if you see some of my content, we're tracking with AI, not me, but there's a couple of charts that track with AI, his speeches and his language, and he is becoming more dovish. He's becoming more dovish. Just so happened when the RRP or the reverse repo facility started unleashing liquidity back in the market. So he's becoming a little more dovish. And at the same time, he's more optimistic about the economy. So I don't think that changes, guys. I think it's the same thing. But again, hey, these questions will be interesting. We got to keep track of these questions. So if you're on TikTok, go jump over. We are live on Bluetooth. We're live on Bluetooth. Keeping track there. We got about 7 minutes left. So see what else we're getting here. Let's get this off. Take this off. Nothing changed in that language. So far, S&P can't get above VWAP either. We are struggling to get above VWAP. The dollar is starting to move up right now. It did sell off initially on the rate decision. Now it's starting to move up. We are now, Fed funds rate, we are now at 5, from 5.25 to 5.5. So if you're new to how the Fed works, the interest rate is actually not just one rate. Is he coming up? Or are they just showing up? The interest rate is not just one rate. It's a range. It's a 25 basis point range. So we were at 5 to 5.25. Now we're at 5.25 to 5.5. We're at 5.25 to 5.5. So he should be coming up here 5 minutes. And I'm going to keep track over here. Live FOMC. The dollar's still moving up. Bond yields. Let me switch this to bond yields. Right, the bond market is tightening as we speak. The bond yield's tightening a little bit. This is minute to minute, though. This means nothing. This really, what we want to do is see how price responds to his comments. How is price going to respond? How's the bond market? How's the equity market? How is the currency market? Well, really the dollar. I'm going to respond to his comments. Just neutral right now. We're just seeing all neutrality right now. Nothing up, nothing bad, nothing good, nothing negative. Just all neutral. So yeah, it's all about his comments. It's all about his comments. Does he signal a pause is a big question. Does he signal a pause today? I doubt it. I really doubt it. He might try to stay data dependent. My guess is he says, we're going to stay data dependent. That is my guess. We remain data dependent. So yeah, we're going to watch how the dollar responds to his comments. The bond market, I don't think the oil market really matters, honestly. I think the oil market's a little isolated on its own. Crypto doesn't really matter. Crypto's going to go with the equity market, more of the risk type of plays. Well, to finish the day, we have the Dow up, making new highs again, 52-week highs again. Okay, S&P now selling off. Everybody's worried. They already made the rate hike. 25 basis points. Dollar really trying to bid up here. I'm going to move this chart over here. There we go. All right, here he comes.
Is this a market that has accepted that, do you think, or does it need that messaging from the Fed today?
Well, I don't think the Fed can really give that messaging with any certainty because, people talk about a soft landing, but the truth is the economy never lands. I mean, you've always got another quarter, and sooner or later, winter is coming. We don't know when winter is going to arrive, but it will eventually arrive. Eventually, we'll have a recession. Eventually, we'll have a month or two where payroll gains are negative. And at that point, the Fed's going to have to cut rates. We think probably get through 2023, but sometime in 2024 that could well happen, and then the Fed has to cut. And by the way, when the Fed has to cut, the first cut will do nothing to help the situation. What we've always seen is that when the Fed raises rates, it's kind of like going up an escalator, and when they cut rates, it's like going down an elevator. And so the Fed, their own projections say they'll be able to bring rates back down to their neutral rate very slowly. Never happened. So I think the market may be looking at that. They realize the Fed's being very aggressive right now, but they won't be very aggressive forever because a landing won't stay soft forever.
What is as you look at where stocks are today and where they've come, as Melissa points out, 5 percentage points higher than at the last meeting. What do you think the path for stocks is over the next 6 months?
Well, I look at valuations a lot, and I do worry about the mega cap stocks that have really led this charge. But overall, I think it could be pretty good because the key point is eventually inflation is going to get back down to where we were in the last decade. It's going to get back down to 2%. Eventually, the Fed's going to have to react to a recession and cut rates back down again. And so you get back into a slow growth, low inflation environment in which companies are very good at maintaining margins. I mean, that's the other message from the earnings reports that we've seen so far this month. There's a problem on revenues, but they're doing a great job of maintaining margins. And I think U.S. companies can do well in a cold climate. And I think I think the stock market is taking some comfort from that.
Do you want to continue to be in the parts of the market that had not participated in the first half of the year that have just shown signs of life recently?
Yeah, I do. Because if you run into a bump in the market, a problem, the very things that
S&P is pretty neutral. It's pretty neutral. It's finding some buyers at 454 right now. Yields are sort of climbing. The dollar's right back to where it was. He's about to step out. Just keep in mind there's a lot of cash on the sidelines. So if there is any dislocation with his words, I don't think there's really a lot to sell off, but we could sell off, but the buyers are going to step in on any, because the Fed is set to be more optimistic about the economy and a little more dovish, just slightly dovish. And there's a lot of algos that are going to read that. And I think this could be a buying opportunity. Even though it usually plays out over the next couple of days, and we still have earnings, right? We still have Apple earnings. We have Amazon after the close, Amazon, Meta, it's Meta. I'm sorry. We have Meta today after close. Amazon's tomorrow. So we still have a lot of big earnings to get through before there's any clarity. We're just going to filter through his comments. This is not really the biggest difference is literally going to be if there's something the market is not expecting. So far, the market already priced this in. It's priced in another 25 basis point hike. It's like, whatever, you've already done 500 basis points of hikes. What's another 25, right? So I'm going to be looking at the CME data to see if it's pricing in another hike in, what should it be, August, September, August. I'm going to go check on that. Again, if you want to see the video, oh no, I have it live now. Okay, here we go. Let's go.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path as it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen We've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. You know, we've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but doing, you know, performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's, you know, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but, you know, we're going to be careful about taking too much signal from a single reading. And, you know, growth came in stronger than expected. So that's how we look at it. And so we did take that step today.
Market is breaking out. New highs, S&P 500.
Tim Rose of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter. And that by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here? Or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, you know, how much of this and how much of that. You know, we'll be looking at everything. And, you know, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, you know, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down.
Yep.
So you are really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3% or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements.
Really good question.
Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels. to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. And what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. So among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy. And there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags plural that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate.
Restrictive.
So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data. And given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is the growth rates edging down towards and below, heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source. But I think what matters is the overall picture is of tight and tightening lending conditions. And that's what this SLOOS will say.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So interesting question. So let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and crude prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing. And the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both.
Come on, shelter. Mention shelter.
Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods.
Reversal. There we go.
Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply, but there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions. And that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Good question.
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And not,
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole, on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates. And that won't be this year, I don't think. It would be, but many people wrote down rate cuts for next year. I think the median was several for next year. And that's just going to be a judgment that we have to make then a full year from now. And it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think, that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make. Informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway, And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions, and consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
By the way, it will interpret this at the end. We'll interpret this.
Keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So, in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt. But people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Banc of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point? And how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized, capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that, that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy, is that bank credit conditions bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Large reversal, S&P 500, big reversal to the
Hi, Chair
downside.
Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. Of course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle-class people have some resources and can absorb inflation. The people in the lower end of the income spectrum have a harder time doing that. So we need to get this done. And the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today. The decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
No. I mean, was there doubt? I would say there's a range of views on the committee. And when you see the minutes in 3 weeks, you'll see that there's a range of views about what we should do at this meeting and what we should do at the next meeting. And it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others. And I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed and being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right; it's the dollar and equities, but we're of course very focused on rates and our
Dollar
own
is
policy.
falling.
We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could, imagine it's a world where things are okay and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Thanks, Chair Powell. Kyle Campbell with American Banker. I have a question about the discount window. I'm wondering if since the bank failures of the spring, if you've seen signs that banks have taken more steps to be proactive in assuring that they're ready to use that facility if they need to. And if you have any sort of thoughts on whether policies might be appropriate for making sure that banks sort of test regularly to show that they are prepared to use it. Thanks.
So that's a very important thing. Yes. And yes to both sides of that. Yes, banks are now working to see that they are ready to use the discount window, and we are strongly encouraging them to do that, banks broadly. We did find, as you know, during the events of March, and that that it's a little clunkier. It can be a little clunkier and not as quick as it needs to be sometimes. So why not be in a situation where you're just much more ready in case you need to access the discount window?
Mr. Chairman, Mark Hamrick with Bankrate. You've talked in the past about getting the housing market back into better balance, excuse me, and also that the market might have bottomed. Where do you see that situation and balance or lack thereof right now, particularly with the constrained inventory of existing homes that might otherwise be coming onto market at a time when existing homeowners are reluctant to move? And of course, all of that happening with the 30-year fixed rate mortgage still around 7% on the heels of Fed tightening, and with what you're talking about, tightening industry lending standards. Are we getting closer to balance or farther away? What's your sense?
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up. On the other hand, there's a lot of supply coming online now, and there are people coming in. A lot of the buyers are first-time buyers coming in at buying it, with these relatively elevated mortgage rates. But I think this will take some time to work through. Hopefully more supply comes online, and we work through it. We're still living through the the aftermath of the pandemic.
We'll go to Nancy for the last question. Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Russia has pulled out of an agreement allowing shipments of grain, safe passage through the Black Sea, and alternative routes at this point could be closed off. Just wondering, how could that contribute to higher food prices and inflation generally, and how closely are you watching that?
We are watching it, of course, very closely. And you're right, the withdrawal from the Black Sea Grain Initiative does raise concerns about global food security, particularly for poorer countries that import a large share of their food. Grain prices did go up on this news, but they remain well below their peaks of last spring. And the moves that we've seen so far, I would say, are not expected to make a significant contribution to U.S. inflation. Of course, we will be watching that situation carefully.
So you don't think it would have a big effect on Fed policy at this point?
You wouldn't say so looking at what we know now. Thanks very much.
All right, so we're gonna do a review. Okay, the grain
That
bill.
was the Fed chair after another 25 basis point rate hike, the Fed's 11th since this all began a little more than a year ago. In terms of the big question.
Okay, whatever. We are gonna do a review before we get out of here. What did he say? What did he not say? What is he signaling for the future? How did the markets respond to that? And for that, I'm gonna flip on. I'm gonna get these charts up here. All right. Let me know if the audio is working. So closing bell. We're gonna go to the macro charts. Where's our macro charts at? There we go. All right. So put myself down in the corner here. All right. So yeah, let's find out exactly what we just saw here. Oh, that's a wrong chart. Sorry. That up. This one is really tight. What are we on? Motley Fool. Got this a little mixed up. Is this one? Yeah, there we go. All right, I was reading Teladoc earnings report. All right, so what did we see here? Let's open this up. Is that a? Oh, okay. We'll see what that guy says. All right, so let's check this out. All right, let's look what's going on here. Let's talk this through. First, let me so first off, we got the dollar selling off. So that is a risk on signal. The dollar's at resistance, right? So the dollar's starting to roll over, and that just basically means that easing financial conditions. That was a good report. The Fed is admitting that, hey, inflation is coming down. We're in restrictive territory. Not terrible. Go to the 2-year, which kind of copies the kind of replicates the Fed funds rate. It also dropped, right? It's not dropping so quickly, but it is dropping. The S&P also went up sharply on the comments, and then came back down. All right. But really the key here, what is the dollar going to do? So we'll keep our eye on that. And I'm going to go through some of the comments I made on YouTube as he talked. All right. So Powell says the economy is expanding. Housing is bottoming. We talked about that, right? Because he's keeping track of certain type of data. So he's saying the economy is expanding. So keep that in mind. Everything shows the economy is not headed for recession. It is starting to expand in the services. That was key. Not the goods, not the manufacturing, but the services area is starting to expand. The housing market is bottoming. It's still in recession. We talk about that on the report. By the way, if you're not informed on our MAC report, it's free. Link in the description. I come out with it pretty much every week. A bunch of charts, commentary on the macro, on the economy, and what's changing with policy in the stock market, XYZ. All right. So still in recession, the labor market is healthy. Inflation is well above target. He mentioned that PCE is at 3.8%. That is the Fed's preferred inflation gauge, PCE, and that is still at 3.8%. They want to see that in the 2s, but who knows exactly where. Core is at 4.8, a little higher. That's supply, but hey, that's a lot of that is due to shelter. CPI is at 3, which he mentioned is better than expected, and core at 4.8. Okay, long way to go, he says. Okay, the economy is expanding, housing is bottom. Oh yeah, that's the same thing. So he's basically signaling here that they're still going to be data dependent. This is still going to be data dependent, right? And the market did pretty well on that. So what data? The question is, what data are we talking about? What do you mean data dependent? Okay, we will reduce the balance sheet. We know there are lags, so data dependent. The balance sheet just means he's saying we're going to keep pulling liquidity out of the market, but that's okay because Joe Biden and the White House is still pumping liquidity, and he knows that. All right, so we want to see growth below trend, right? So below trend right now, growth is slowing. Above trend would be above 2.5%, somewhere around there. We're at 2%, 2.4%. We're still slowing. The dollar tanked off that. So once he said, and I could be misquoting him here, but once he talked about that, them wanting to see growth below trend, that's exactly what we're seeing. We're seeing growth below trend. We're seeing growth slow down. The dollar tanked, risk on. Yields came down, also risk on, because yields coming down is an easing of financial conditions. Okay. The next meeting, by the way, isn't till September. It is July. So they got the market has a whole month and a half to really find its ground, right? Depending on earnings until the next meeting, which sets up for what do people really think? How do we digest this? It's going to take a while for the market to digest all this data. It doesn't happen right away. It's not today. I know people are saying, oh my God, the S&P is up. It's tanking. What's going on? It's just, a lot of it is algorithms, traders, it's nothing. We got days, we got weeks to digest all this data, along with what he said is what they're data dependent on. That's the key here. What they're data dependent on. Okay. Powell admits CPI is better than expected. That was positive for the market. He's saying CPI, inflation is better than we expected. And that we're going to be meeting by meeting, looking for moderate growth. We're getting moderate growth. That's exactly what we're seeing. GDP is revised higher. I think growth is starting to bottom out, but it is slower. Everything is slower. Payrolls, the trend is slower, although better than expected, right? Because the labor market is better. Now, what he did say he wants to see is the balance in the labor market. So less jobs, so job openings continuing to fall so that wages don't get pushed up, right? Because if you have less job openings, then wages, basically, if you have more workers coming into the labor market, then you don't have to compete. They're going to compete for wages. Therefore, wages can come down. The more jobs you have, the less competition. The less jobs you have, the more competition. Just think of it that way. So we want less jobs, more workers coming in, and that's what we're starting to get. Policy is restrictive. This was key. The market jumped on this when he mentioned that policy was restrictive, basically saying, hey, we're in restrictive territory. We don't really, unless we get a surprise, this is we got the market exactly where we want it, right? We got inflation exactly where we want it. We don't want to push too fast, too hard, because we can collapse the economy. And we also don't want to hold up. We don't want to stop yet because we're not done yet, right? We're in restrictive territory. And he mentions, and the market exploded off that, right? We had a big explosion off those comments. It's probably algos. It doesn't mean, hey, we're going up off that, but it's probably algorithm. That's good commentary. Dollar down, yields down, and those continue to fall. Yields are still falling. The dollar is still falling. Okay. Question: why not a pause? He basically said because we're data dependent. He avoided the question. We want progress on inflation. We're getting that. Okay, that's what he's saying. 2 more reports. So he said that he wants to see, before they make a real decision on hiking again, which we don't know yet, he wants to see 2 more reports the next couple months of CPI, which honestly is getting a little shaky with oil, right? This is the big risk. I'm going to throw it on here. Oil energy prices starting to move up. So depending if he's focused on headline CPI or core CPI, I think core keeps coming down, but it looks like headline might be a little sticky now because of this energy surge. It's up like 17% from the lows. Okay. Oil is, and gasoline prices will go up. So 2 more data reports on CPI, jobs, and business activity. Everything that we put in the report every single week, we put this in our report: business activity, the housing market, the labor market, and inflation. So check out our newsletter. It's free. Link in the description if you want to keep up to date with that and hear what I have to say about it. We need to hold and raise rates if appropriate. So he's talking about holding rates, right? Holding rates where they're at. They're basically at the pause. Maybe they hike one more time. I really doubt it unless we get a really big surprise. I think this is it. Now, we keep saying that, but the thing is, we keep getting more upside growth surprises, which isn't necessarily negative, because if the economy starts to expand and you get more workers in the market, you do bring that supply into balance, right? You get more people in the labor market, you get more productivity, more production, and more supply. All right. So raise if appropriate. So if it's appropriate, look at, if oil gets above 84, they're probably going to raise rates because that's going to signal more inflation. But the war in Ukraine is starting to slow down. So this oil surge is mostly due to trading, low productivity. It's not really because there's a surprise. It's because OPEC is cutting production. When you cut production, prices go a little higher. I really doubt it gets above 83.50, but we will keep our eyes on that, as we do every day, 5 days a week through the report. Okay. So if we see some surprises, we may hike. Okay. Keep hiking. So it's all about surprises right now. He's very optimistic about the labor market. He mentioned multiple times, hey, the economy is very optimistic. Like we said before, the language is becoming more and more optimistic, and I think the market likes that. Yes, the S&P selling off. Yes, the Qs are selling off, but they need to go find support somewhere before you go higher. You don't just keep exploding higher, because we've already been up, right? We have the earnings coming up. As a matter of fact, in about an hour and a half, we do have Meta earnings. We'll see how that mega cap tech company, how the outlook is for their to look further into the consumer. We want to see better supply chains. Hey, by the way, that means less supply chain pressures, and supply chain pressures are collapsing, right? If we look at if you look at the ISM PMI, we see that prices are actually falling. Prices paid are falling, while employment is ticking up a little bit or neutral. And you also have new orders coming in. Okay. So supply chain pressures, delivery times. If you look at the global supply chain pressures index, you can look at it. Global supply chain pressure index, it's below trend. It's back to where it was during the pandemic. What does that mean? That means, and please subscribe if you're new, subscribe, help me with the subscribers. Hit the like if you appreciate the video, if you appreciate the content. Let's get the likes up, YouTube, TikTok, whatever it is. So supply chain pressures are coming down. That is so bullish for the market over time. Maybe not in the next week or the next month, but supply chain pressures are down, and that's really what elevated inflation in the first place. Not just demand; it was a lack of supply. It was China not being able to send ships over here. It was the supply chains being constrained. They are no longer constrained. They're getting better. He also wanted to see moderate growth. What are we getting? Literally slower growth. And balancing the labor supply. You kind of mentioned that twice. Fed funds rate is right where we want it, putting downward pressure on growth and inflation. So he mentioned multiple times the Fed funds rate is exactly where they want it. And it's kind of a balancing act because they want to keep inflation lower. Remember, growth and inflation are tied together, right? They're both kind of synonymous. The only issue is when growth starts to reaccelerate, you do get an acceleration in inflation unless there's more labor, unless there's a lot of productivity, a lot of low supply chain pressures, then inflation can stay tamed. So what that means is the growth reaccelerating, it's not really reaccelerating, it's slowing down. That's going to bring down inflation. The core should be lower. We should get lower core inflation. The only reason it's elevated in the first place is because we're looking at the base effects. We've been elevated for a while, right? So to make that simple, what he's saying is we're exactly where we want in the rate cycle. We're exactly where we want without hurting the labor market, without hurting growth. Growth is slowly trickling lower. Perfect scenario for inflation. As I say, this is the perfect scenario for inflation because growth is slowly dropping, but it's not collapsing, right? So you don't have to cut rates yet, or you don't have to worry about systemic banking risks or real estate risks, even though people keep talking about it. The bond market is easing. Okay, that was easing during those comments. Everything is cooling, is what he said. Question: can they achieve a soft landing? He says yes. He's very optimistic about about a soft landing. He's basically signaling that their base case now is a soft landing. Okay, that means the economy doesn't fall apart. It's never happened in history, so this is out of the norm, but it's very possible. And I think one of the reasons why you get that soft landing is, again, the White House Inflation Reduction Act, Infrastructure Deal, CHIPS Act, Internet Initiative. The White House is printing, right? They are creating that supply in the money market. I'm sorry. And they're getting more spending from the TGA refill, right? Their Treasury General Account is going higher. The TGA refill, we talked about it earlier in the stream, because money market funds are now taking their money out of the reverse repo facility, and they're now buying U.S. Treasuries. So when you buy those Treasuries, you are giving money to the U.S. And the reason they're doing that is because the Treasuries are offering more yield than the money market funds, or more than the reverse repo. Hopefully I don't lose you there. Report in the newsletter if you want to know deeper about that. We will stop raising rates. Oh, this was super bullish. If we see inflation come down enough, we can cut rates. So that is one thing he did say. He said that if inflation does drop enough, and hey, yes, is it likely? Who knows? What is your window? What is your window? If oil stays at these levels, it's not going to come down fast. But if oil drops, gets rejected at 83, comes back down, goes down under 74. And the only chance for that is that these other oil producers start increasing production. It goes lower. As the economy slows, manufacturing is still slower. There's not a whole lot of demand for oil. That goes lower, right? Now, that's something we have to keep data dependent on month to month. We don't know what's going to happen there. But if inflation does plunge, and one of the reasons for that could be the shelter prices rolling lower. Shelter prices are falling. We know in the East Coast, New York might be going up, and prices. Cleveland was going higher, and prices. Who else was it? A couple cities were still elevating in their shelter prices, but Phoenix is down. Nevada's down. Seattle down. San Francisco down the most. So a lot of more prices are actually falling than rising. And if shelter prices roll over, that's going to put downwards pressure on CPI. And guess what? Yes, food prices maybe have some risk to it, but shelter prices is big. That's your rent, right? That is your rent. Those are people buying new homes. So we'll keep track of that. Next, he talked about we will stop raising. Oh, this was very interesting too. He said that they'll stop raising rates before 2%. So we're at 3% headline. As inflation trajects lower, as it rolls over, he said they'll actually stop raising rates before they're not going to wait. all of you guys, you hear people saying the Fed won't stop till 2%. The Fed won't. He said it plain. Maybe you don't believe him, but he said it plain. It's clear as day. We're not going to keep hiking until 2%. We're going to stop before it hits there. We just need to see that progress is being made towards 2%. What does that mean? You look deeper into the data, keep track of my newsletter, because we track the data, all the micro data, PPI, CPI, PCE, China's inflation, Euro's inflation, where we're headed next, right? Oil prices, all that stuff, natural gas, whatever it is. So he said that they're going to not go to 2%. They're going to stop hiking before that. He even said, we're actually going to cut rates before we hit 2%, which was very interesting. He said, we'll start cutting before 2%. So they're actually probably going to do a very strong pivot. That language suggests a very strong pivot, which is before we hit 2%, we're going to stop raising rates and then we're going to cut, right? Maybe it's a month in between, 2 months in between, who knows? But that is a pivot that he's talking about. So the closer we get to 2%, the more the market can start bidding up if earnings, actually do bottom out here. And if the earning internals look good. Right now, they look good, but a lot of stocks are advancing versus declining. We're getting market breadth, meaning a basket of stocks across the S&P are moving higher. The equal weighted baskets are moving up. Tech is taking a breather. Dow is moving higher. Value stocks are up. IWM is up the most in the last month. So markets are moving up, right? There's a lot of risk being taken. There's a lot of cash on the sidelines still. And with every pullback, which we might get in the next couple of days, the next couple of weeks, those should be bought up. So it's all about inflation as usual. Bank risk. They mentioned bank risk. Bank risks are low, tightening. What do you say? Bank risks are low. And that's because the bank term funding program, they unleashed back in March when we had the banking crisis. If you didn't already know, emergency lending facility where banks could borrow and cover their deposits. The banking sector is fine. That's why we see not ITB. That's why we see the regional banks, KRE. Here's a KRE exploding, right? This was the banking risk that we saw. Boom, it slipped. Let me take this off. Banking risk slipped. We saw the regional banks collapse, and now they're exploding, right? They're up from the lows. KRE regional banks are already up 41% because the banking risks are disappearing. And I have this highlighted because that is where they unleashed the bank term funding program. They unleashed money on the balance sheet. So if banks do roll over, more liquidity for the market. Not too worried about that. Oh, and it just so happened that, watch, check this out. It just so happened when they did unleash that liquidity, that is where the S&P had a big bounce. Look at this. The banks fell, they unleashed liquidity, S&P bounces higher. And that was kind of the pivot point before we tested 4,200. So very optimistic about that. Okay. Banks are rising, tightening, but in line with the path. He also said that bank risks are low. There's a tightening of credit, but in line with the path, meaning yes, credit conditions are worsening and banks have less credit, but that is exactly in line with what they wanted to see. So again, they're more optimistic. You got to trust the Fed. Do you trust them? Do you not trust them? It's not a matter of trust. It's a matter of, is what they're saying aligning with the data? So far it is, right? You can't trust exactly. Like last year, they said, we're never going to raise rates, but inflation is going much higher. They were wrong. Right now, inflation is going lower. The economy is rebounding. And that is aligned with him saying the economy is bottoming or the economy is not falling apart. That's in line with no recession. So everything is aligning. The data aligns with his comments, right? You want to see transparency. You want to see the data align with his comments, not the other way around. All right. Somebody asked about the FOMC. What are the range of views on the FOMC? They're all different views. We'll see the minutes in 3 weeks. Okay, we'll get the Fed minutes in 3 weeks. Teladoc flying today. Yeah, Teladoc exploding. Let me see, TDoc, because healthcare is moving up. Dang, it finished at the highs too, 29. I'm looking for that retest. I'm looking for the retest on Teladoc. It looks really good. All right, so that's the wrap up on the Fed minutes. Basically, the market is not going to just explode because he said so. Like there's no disallocation. Everything's right in line. He said we're going to hike rates 25 basis points. No surprises there. So the market's going to chug sideways. It's all about earnings. And we have earnings coming up after hours at 2:00 p.m. All right. So if you haven't already, sign up to the newsletter so you can get the insights from my newsletter. The insights we get every day, charts. I put on their charts, market sentiment, right? Also, we will also show the biggest risks. Again, oil is the biggest risk to the market. Okay. Oil is the biggest risk to markets. Do we got any questions before we move on? Or actually before I end the stream? I think that's about it. Powell is very optimistic. His language is optimistic. They're in restrictive territory. Inflation is coming down. The only risk is oil prices are still surging. Hey, the dollar's rolling over. That's very optimistic. So I think that there's some liquidity leaving who knows where, leaving the dollar and starting to become more risk on. This whole signal was, can you explain more on oil? Yeah, oil is the biggest input to inflation. And so headline, at least core, no, not core, but headline inflation. So as core, like oil has these two zones here, 83.50 and 75, right? If it moves sideways, inflation comes down slowly on the headline, right? It'll still come down because even if oil is flat, that's zero inflation, right? That's zero month-on-month inflation. So oil, though, did bounce from the 60s all the way back to 79. So that's going to price in next month's CPI, which is August, right? What we're seeing now in oil, the move we see in oil today doesn't go into CPI till next month, which means next month, we're not going to see a very sharp drop in CPI. We've been seeing 1% drops from 4 to 3%. This time, we probably do crack the twos. We probably crack the twos. As a matter of fact, I want to see, we'll come on, stay tuned on the lives. We'll see what the expectations are. We probably crack the twos, but not far. Now, if oil breaks above the 84 level, 83.50 level, then that's going to be risk off. The Fed could definitely hike in August and keep saying, hey, we might hike again, because that's energy inflation going up. Unless core absolutely collapses by that time. We don't know. So oil is important because it's the biggest input to inflation. That's the whole thing there. It's a big risk. But hopefully the dollar comes down. Yields didn't really react. Nothing to, so data dependent. Here's the information they're dependent on. Business activity, which we track every week. They're data dependent on the labor market, which we track every week. They're data dependent on CPI, PCE, PPI, which we track every week. Just keep this in mind. PPI is going negative. Producer prices are going negative. Those help margins of the equity market. I expect earnings to bottom. We're seeing earnings starting to bottom in some areas. So I expect earnings to bottom. Producer prices are lower. And it really just comes down to oil. We just need oil down, and the equity market can continue to elevate. Teladoc, yes, Teladoc is flying. I'm looking for the pullback maybe tomorrow, maybe at the end of this week. We'll see how that goes. Still holding Zoom, but Teladoc looks solid. They had a pretty good earnings report despite being negative. Hey, it's down a lot. All right. Well, that's all I have for you guys. I appreciate you guys coming into the stream. If you have more questions, I'll be live again tomorrow. We'll have a short session tomorrow. I might even come on a little earlier for a market open. Have some family stuff that I'm going to go do. I haven't took a break for the past year, so I'm going to take a small little break. And we'll probably have like a 60-minute stream, 45-minute stream tomorrow morning, and go over whatever questions you have. Let the market digest this, what Powell just said. Jeffrey Gunlock. Maybe I'll catch some videos on Jeffrey Gunlock in the bond market. For the most part, the Fed's pretty much done. We're paused. The market very optimistic about that. That's why we see financial conditions starting to ease a bit, and we'll see what the market does. All right, guys, appreciate you guys. We'll catch you tomorrow. Thank you for joining. And stay blessed today. Stay blessed.